I've been doing weeks worth of research and I'm going all in on a single ETF, VGT, and in this video I'm going to tell you exactly why. To highlight what I'm going to talk about, first I'm going to start with touching on why tech ETFs in general, and there is more than just AI. And then we will dive deep into why VGT compared to other tech ETFs. So everyone is talking about AI and how the tech sector in the ETF is looking good thanks to it, but these are old news. People have been saying that the tech bubble has burst, but now with AI, everyone's back on the hype train. But I believe that the tech sector is going to explode in the next 10 years. Not only because of AI, also because of quantum computing, and especially because of the symbiotic relationship between the two, which I'll explain in a moment. Tech giants like Microsoft are committed to evolving quantum computing beyond the state of the art within the next 10 years. And if AI is already assumed to improve and become even more powerful, it's going to be empowered with quantum computing because fundamentally, AI depends on processing power that's needed for solving optimization problems and enhancing machine learning models. Quantum computers provide an unimaginable improvement of processing power compared to classical computers. And that will be the driver for developing AI at even a faster rate, perhaps to a point where it's scarier to go beyond. To give you some perspective, imagine that all the data and optimization processes that ChatGPT 3 had to go through to become ChatGPT 4, let's say at a minimum couple of months, with quantum computing that can take seconds. I know it's kind of hard to grasp how something like that can be, but this is really what quantum computing can give us. It's multiple orders of magnitude of an improvement. This in itself already puts tech giants with resources and human capital at a major advantage to building a capable quantum computer and be the first to market. In addition to that, other breakthroughs include electric vehicles and Internet of Things that can really skyrocket into the next level and have a much more personalized user experience and become energy efficient. Finally, the company, quote unquote, with the highest revenue in the world, the US government, with more than $5 trillion annually in revenue from taxes. That's more than the revenue of the top 10 companies with the highest revenue worldwide combined, is going to increase its investments in technology because not doing so would mean falling behind, and that would be a threat to national security. And if you're asking yourself who would be the best poised for being contractors for projects the government is interested in, it's big tech, of course. So sure, a lot is happening in the tech sector, but why VGT when there are so many other tech ETFs, such as XLK, IYW, and SMH? It boils down to holdings. The two dominating stocks in VGT's portfolio are Microsoft and Apple, with more than 30% of the funding allocated to these two stocks. Both of these companies, in my opinion, have a strategic advantage with where the technology is going. If we break down the tech sector into the segments of AI, quantum computing, electric vehicles, and Internet of Things, semiconductors, and the cloud, we can see that Microsoft is spearheading AI because they're the main investor and a strategic partner of OpenAI, and they're allocating billions of dollars for developing quantum computers. To date, they have also been the main competitor of AWS in terms of cloud technology, and with quantum computing, they might even take over the market and dominate in terms of profit margins for the least. Apple, on the other hand, has been heavily rumored to be deep in the process of developing their own electric car. And after just recently releasing their augmented reality headset, Vision Pro, along with other wide range of devices and integrations, they are best poised for leveraging AI to create the most personalized human-computer interaction experience the closer we get to a general artificial intelligence. Broadcom and Nvidia, who are the largest players in the semiconductor sector in the US, Nvidia is primarily known for state-of-the-art GPUs and AI accelerators, and their target market is the gaming industry, data centers, and AI applications, while Broadcom is prominent in wireless connectivity, telecommunications, and networking chips. Now, Taiwan is currently the undisputed raw semiconductor manufacturer led by TSMC, which is a company of a market cap of $500 billion. And that also might change because the US has said that it wants to invest in the local semiconductor market to move the production from overseas. And that's going to be done by companies like Intel and Qualcomm, which are in the top 15 holdings in VGT's portfolio. Apple, Microsoft, Nvidia, and Broadcom make up more than 50% of VGT's holdings, which is the main difference between VGT and other tech ETFs. In most other ETFs, these four stocks make up substantially less of the ETF's portfolio. But there are exceptions like the Technology Select Sector SPDR Fund. XLK has been established in 1998 while VGT has been established in 2004, but the main difference is how the rest of the portfolio is allocated. XLK tracks the Technology Select Sector Index, which is composed of companies in the technology sector from the S&P 500 index. VGT, on the other hand, tracks the MSCI US Investable Market Information Technology 2550 Index, which is designed to measure the performance of the information technology sector in the United States equity market across all market caps, small, medium, and large. In simple terms, what this means is that XLK is focused on the large Fortune 500 companies, while VGT is also invested in the small and medium cap companies. And this is what primarily differentiates the asset allocation of the remaining 50% in VGT's and XLK's portfolios. VGT also passes the basic due diligence you would do for any ETF. It has large amounts of assets under management for liquidity, and it also has a successful track record of performance. It has a low expense ratio of 0.1% and an annual dividend yield of 0.68%, so it's more than 0.5% of a net positive on that end. Now, obviously, I was not optimizing for a dividend yield with an investment in a growth ETF, but 0.5% on top of appreciation is a sweet bonus nonetheless. Finally, the last reason I'm looking to heavily and passively invest in a single ETF is to free up time to do other things. This way, I also reduce the risk of making bad decisions because I have so much time for analyzing weekly trading decisions. Instead, I'll just keep a smaller amount in the account to dedicate for options trading or investing in individual stocks and other things, which you can see more about here.